So my name is Rod Turner. I am the founder and president of Manhattan Street Capital. We specialize in Reg A+. I expect most of you are aware of that. We host offerings, we consult and quarterback and help our client companies to succeed with their offerings. And we aren't, but from a disclaimer point of view, I want to make it clear to you that we are not valuation professionals. We're not securities attorneys. We're not broker dealers, and we're not underwriters. So bear that in mind. Whatever I say, I'm going to give you my best advice, my best guidance here. And I'll give my, that's the point, but I cannot tell you what to do. I'm not doing so. I can tell you what I think will work, and I can tell you, help you learn from what I've learned in this space as a Reg A+ specialist. I launched this company 5.5+ years ago, focused on Reg A+. We do some Reg D offerings, but the primary thrust has always been about Reg A+ from the beginning. A little background on me. I've had the good fortune to be a co-founder or senior executive with 6 prior successful startup companies that we built to liquid outcomes. I've had failed startups too. I've done 2 IPOs to the NASDAQ where I was one of the top executives. One of those was Symantec, the company that makes or made Norton antivirus. We grew by acquisition, which is relevant to this conversation, in that we added numerous acquisitions to accelerate the growth of Symantec, and I headed up the mergers of the most strategic, the largest, most opportune acquisitions, including that of the Peter Norton utility business, which is the business from which we launched Norton antivirus and built it to be the leader in its market. Okay, so most important thing about, I'll go through the agenda here. Actually, let me just do that. That's the next item. I'm going to compare Reg A+, the method using Reg A+ as an alternative to a SPAC. From a big picture view, I'm going to go into more detail about what the specifics are and how they contrast in terms of the advantages and disadvantages of using Reg A+ in this way. I'll start off with the disadvantages and then move into the advantages. And then I'll get into tripping hazards around that strategy, that plan. Then I'll talk about which method of going public via Reg A+ to use, underwriter involvement, marketing and cost and schedule, liquidity, which is pretty straightforward in most of these cases, OTC options, and post-IPO, what's needed if there's time. That last one there is optional. I also have some other tips and techniques I'll get into if there's time, but we'll see how this goes. I don't want to be speaking so fast that you don't get to hear or register what I'm saying. But on the other hand, there's a lot of different issues here that would be nice to cover if there is time. So without further ado, getting started here, we have someone waiting to enter, Akos. Akos, thank you very much, Akos. Akos is a great guy, and how thorough. Will there be a presentation that will be available? No, this will just be me talking to the subject in as value-added a manner as I can. We will record this webinar, and we'll put it on a blog on the Manhattan Street Capital site, which will have a clickable index, so you can just look at the bits you're interested in and not watch the rest. That we will do. Okay, it's already being recorded. Big picture view. The big picture view shows that you can do things. You can use a Reg A+ to do broadly. Actually, before I get into the big picture view, let me make a couple of things very clear. The SEC did not recently amend Reg A+ to include blank check companies. They did not do that. I'm going to let Etan in because he's waiting. Okay, good. The SEC did not suddenly make that change, and I'm here to tell you about it. That's not the case. You cannot, with the exception of real estate, where there have been many Reg A plus offerings for essentially SPACs for real estate. That has happened on many occasions where companies raise money with the intention of going out and buying stuff, and the stuff was always real estate. And those companies have raised, in one case, Fundrise is probably at $1 billion cumulative now on Reg A plus offerings. And Ground Floor Finance was the first one to use this approach. But it's been very common in real estate. However, the SEC treats other kinds of companies in a different manner. So I guess the first thing I want to say here is that you cannot go to the SEC and file a Reg A plus and say it's a SPAC, because they won't allow that. They won't allow a blank check company. So what I'm doing today is presenting you with a method or a combination of legitimate methods by which you can use a Reg A plus to accomplish the same goals as you see in a SPAC, but by a different method that isn't called a SPAC. It's a Reg A plus. What name to call it, I'm not sure, because I think anything remotely SPAC terminology use, any remotely like SPAC terminology that you might use would be a problem with the SEC, I imagine. So big picture view, let me just drink some water here. Big picture view, in both cases, you can raise capital, you can go public, and then you can buy companies. That's the big picture, simple view, and that's a similar thing. And you can use the heat in the market and the excess capital that's available in the markets. And in both cases, they're relatively simple methods by which to move forward and execute the strategy. But now we get into the more important part, which is, hey, what's the detail of this? So I'm going to exclude real estate for the reasons already stated, right? It's the exception that proves the rule, as my mother used to say. We have another person waiting. Akos, I need you to let them in without my having to do that. Thank you. So where was I? Yes. So I'm going to set aside real estate because most of you probably aren't planning to do a SPAC or a Reg A plus equivalent for real estate. If you are, you've got an easy option before you. The disadvantages first of Reg A plus in comparison to a SPAC. It's capped. You can't go out and raise $300 million. You just can't do that in 1 year. You can raise 50 to 75. At the moment, the regulation change to 75 million is on hold because the new President Biden has put a hold on a whole bunch of things in order to figure out what he wants his people to do. And the SEC had not at that point, and they turned $75 million max Reg A plus effective. So that's currently on hold. We'll see how that plays out. The disadvantage is, though, annual cap in a Reg A plus of, at the moment, at this instant, 50 million a year. That the SEC will not allow a Reg A plus IPO to list on, that is the SEC, I said that. The NASDAQ will not allow a Reg A plus IPO to list unless it has 2 years of operating history. And that can't be, you buy a shell company which has been around for 20 years, but the last 2 years nothing happened. That doesn't count, right? There's no operating history for 2 years. There's a tiny amount of money flowing here and no real business. So it has to have an actual history over a 2-year period at the point of time that you want to list the company in order to do so. So that's a limitation of Reg A plus. And another one in this method is that the SEC will not allow you to make a plan to buy companies and just go raise the money. They'll allow that with real estate, but they will not allow that in. Yeah, you're welcome. It's funny, I'm seeing the comments. I don't normally see them. It's a bit distracting. I know later on I'll figure out how to turn that off. Okay, so where was I? Yes, the big issue here, which is manageable, but it's still a big issue, is that if you must have a legitimate business purpose. It doesn't mean that you have to have been in business for the SEC Reg A plus filing I'm now talking about, if you launch a new company, you can't just go to the SEC with a company and say, we're going to buy electric vehicle technology related companies and it'll be a wonderful story. You can't do that. That's a blank check company by the SEC's interpretation of that term. What you can do is build a team that has credible skills in electric vehicle technology and have a plan to build your own technology that is legitimate. It can't be that you're playing games with the SEC, right? You can't, no one wins in playing games with the SEC. Trickery never works out, obviously, right? So I'm not advocating that by any stretch of the imagination. But you could, for example, build a technology that is additive and that is valuable in its own right, that makes the business a business. And part of the business plan is to grow by buying companies. That is an entirely legitimate thing to do. And then it's a matter of how great are the companies you find, how much you pay for them when you buy them, and how much money you raised in your Reg A plus, et cetera, et cetera. Okay, so that's a very important downside or disadvantage of using Reg A plus. You don't have to have done it. You don't have to have proof that you built it and it's credible and it's tested and it's patented and it's been in the market making revenues, but you do have to have a plan at least to do something legitimate, and that plan must be real. Fair enough? And you can't call it a SPAC, but I think you got that already. Okay, now going on to advantages of Reg A plus in this context. It's more available, right? You know, there are some entrepreneurs are in a situation where they can pull together the team that will command the respect of underwriters, et cetera, in order to raise the money to do a SPAC the conventional way via an S1, more power to them. And some are not in that situation. So it's a broadening of appeal of this method. You can use, there's more founders and CEOs that can make this happen. It's less costly to list via Reg A plus because you're paying the auditors for US GAAP audits prior to going live, and it's not at the beginning of a Reg A plus that will later list on the NASDAQ. This is not yet a listed company, and so the fees you should be paying for the auditor and for the securities attorney are dramatically lower, like 1/3 the price, 1/4, 1/3 the price, depending on who you would go to. Marketing is allowed, it's an inherent part of a Reg A plus, is that you are allowed to raise up to $50 or $75 million via the offering up in a 12-month period, right? In a period that is up to 12 months of duration. So the ability to market the offering can be very powerful in building brand awareness and building momentum and preparing the way, and also building strategic potential, right? It's a lot more interesting to a potential acquirer if you are in the process of raising money and your company has been SEC, your company's offering has been qualified by the SEC. One of the things I hadn't anticipated about Reg A plus is that our client companies, by dint of having been qualified by the SEC, get much better treatment from potential strategic partners. It makes sense, right? I just didn't anticipate that. I said it's also a faster SEC process than an S1. An S1 is a seriously challenging process to get through the SEC for all sorts of valid reasons. And a Reg A plus is challenging too, but it's a heck of a lot less challenging when it's done properly. When it's prepared properly, then the Reg A plus offering is much easier. The Form 1A process is a much easier journey through the SEC. Typically 60 days to get through the SEC process is the norm that we see. They've been much faster than that. We've had a couple of really delightful exceptions that were much faster, but expect it to be about 60 days as long as you are preparing and submitting the Form 1A in a proper manner, in a way that is unlikely to cause all sorts of grief. We help with all of that for our clients, obviously. One of the things that's inherent in SPACs is that they raise the money, and typically they'll allow themselves 2 years to go out and buy target companies and use that money. And if they don't do so, they refund the money. And then everything ends and it's, oh dear, what a waste of time that was, which is fair enough. If you're doing this via a Reg A plus, I don't think that's such a smart thing to include in the offering. And you have a real business anyway with a real plan. So it's, I think, a better model, frankly. I don't like, from a SPAC point of view, there are there's a lot of SPACs out there that are funded that are reaching the end of their 2-year window. And you know what that does? It creates a sense of it can create a sense of desperation where companies go out and willy-nilly buy stuff just to keep themselves going and make money out of this thing, which is definitely not a positive, not a constructive dynamic. I don't like Personally, I don't like deadlines of that type if I can avoid them, but that's certainly the case. In a Reg A plus, you could do that, but I would recommend not to. I would recommend that you raise the money you need, you grow the business, and you do it in a legitimate manner. Okay, good. In a legitimate manner. Reg A plus is very flexible. Of course, if you're doing a Reg A plus where we get significant enough underwriter support that we're going to qualify and then immediately do the IPO, then in that case, you don't really have that much flexibility because you've got a pre-money valuation. You've got you can change that, of course, if there's excessive demand or insufficient demand for the underwriter. You can change the price up or down in a Reg A plus. Where it gets to be lovely is when you are raising money online prior to engaging the underwriter. And I'll talk about that more in a moment. Because you are allowed to change the share price and the valuation as you raise money, according to developments in the business or other items, other issues. When you set up the Reg A plus properly, you are allowed to use proceeds of the raise to pay the ongoing expense of raising money. The biggest single expense is marketing and being able to make escrow closes as you go from day one by establishing a zero minimum capital raise for the Reg A plus. That makes it a lot easier to fund, where you don't have to pay all the capital expense of raising whatever, $50 million prior to closing, right? If you have a very high minimum, that's a seriously expensive expedition. Not the best use of language, hey? And of course, in a Reg A plus that is offered online, which is the norm, we find that Main Street investors are the easiest to reach. That is to say, regular people who weren't able to make investments of this type in the past. They are the easiest to reach. They're the ones that are most attracted to the right kind of offerings, and I'll get into that in a minute. And they're optimists, and they're, the average investment amount, the highest we've seen in a Reg A plus so far that we've been involved with is $8,000 average investment amount, and the lowest is $1,400 average investment amount. So you get a lot of investors. That puts off a lot of people, but guess what? If you're public through your SPAC, you're going to end up with an awful lot of investors too. And this is a regular thing with being public, right? These investors tend to be effective to work with. You bring on a transfer agent, of course, and most of the day-to-day stuff is handled by the transfer agent. Brand ambassadors. Whilst you are raising money, you are building brand ambassadors, and that can be very valuable depending on the focus of the business. Now I'm going to talk about tripping hazards in this approach. What you plan must be what you do. You can't game the SEC. You can't come in and say, oh, we're going to do this, and then not do that. You have to do what you said you would do, right? That's a tripping hazard to be fully aware of. Don't call it a SPAC. That's just not going to fly, because the SEC won't allow what their definition of a blank check company, unless it's a real estate business. And if you plan to raise the money online, will the company appeal online? That is the single biggest constraint to this online crowd investing business that we're focusing on every day, is does the offering appeal to Main Street investors is it compelling anyway? Of course, it has to be compelling, but is it easy to explain? Is it easy to explain it in an ad through social media, which is the most effective way to reach these folks? So not every company has strong potential appeals online in a practical way, right? So then we're left with the debt offering, where it's the interest rate that's exciting, or you shouldn't do an online crowd investment raise if it's something which cannot carry either the one or the other. If you're selling shares, it's got to be easy to explain. You can imagine that a company that is planning a roll up through of the SAS businesses that are doing trash truck routing is going to be a tad difficult to make appealing. It might be that the metrics of that business are phenomenally exciting, and then you're talking about the metrics of the business and the overall the trends in that business and how many targets there are to acquire, and that might end up making it appealing. But what it's doing is dead boring, right? So it ends up being a story of here's a clear success and here's why. You can't predict what the company will do, but you can show what the opportunity is. Reg A Plus is all about marketing. It's about excellence in marketing. It's about all of the integration between the marketing and the platform through which you are raising the money. Like, I'm biased, Manhattan Street Capital, where we do a phenomenal job of that. That matters intensely, so you can tune the efficiency of the marketing, right? Marketing is everything in an online raise. And an important one too is the bigger the raise, the more valuable, excuse me, dry mouth. Dry mouth. The larger the raise, the more important it is or can be to bring in family office investors. So that implies that the offering is strategically attractive and that the valuation is attractive also, right? So Main Street investors aren't very hung up on valuation. We, that is the issuer and my company, want valuations that are reasonable so that the investors are happy later, of course. But family offices may be more demanding on the valuation front. That's worth figuring out early, which we can do, of course. We can approach them whilst the offering is in filing with the SEC. But the other issue is the primary issue is this offering, is this company strategic? Is the combination of what you're planning to do strategic, such that accredited investors, yes, but family offices in particular will want to engage? That can be very helpful in getting early keystone investors on board and filling out the raise. Because let's say that the 75 mil gets okay, and let's say we're raising all of that online, it can be challenging. It is challenging. Excuse me, no, I can't. I understated that. It is challenging to raise $75 million in 12 months cost effectively. There's a heck of a lot of skill, science, art, you name it, and paying serious attention that goes into getting the cost of that raise down. Big deal. So strategic appeal of the offering will help. Which IPO method? My point here is that if the destination is the NASDAQ, then there are really two ways to go as I see it. One is that we already have enough underwriter engagement, because this is such a hot company, the team is so strong that we can engage them and have the IPO take place almost immediately after qualification by the SEC. So then the 12 months is nice, but you don't need it. You get the whole thing done in 4 to 6 weeks. It would be good to be able to raise money online too, to have numerically more investors. That's what we helped Akimoto with in their NASDAQ IPO. They raised $4 million in 4 weeks online, whilst the underwriter, W.R. Hambrecht, which has since retired the business when he retired from the business, they raised 15.5 million out of the 19.5 total. And they did that in 2.5 weeks, which is the norm, right? So that's one way. In the event that we're not high enough on the list of priorities to get underwriter attention to do it right away up front, which is many times the case. because the market is so hot and there's so many easy pickings for underwriters, then we can go out and raise money online via the Reg A plus and get sizable progress that way. And when there's enough money left for an underwriter to engage and to have them help us finish the raise, it isn't essential, but it's a good idea to do so. So let's say 9 months in, we engage an underwriter. Then say you engage the underwriter with our guidance and assistance and help. And then the company listing is an easy process, and getting serious attention from the underwriter is easy because we already raised, say, 30 million bucks, whatever the number might be, that is enough to make the difference. Yeah, there's a question. I'm going to get to the questions later, otherwise I'll lose my momentum or my place. I'm getting into, so I think I made that clear. 2 ways to go, right? Fair enough. Yes, let's go. Underwriters. We know who the underwriters are that have an interest in doing Reg A plus IPOs and what kinds of companies they want to see. So we have, as a part of our service offerings, the ability to bring them in, to introduce them, and to help you pitch your company in such a way that it's going to get successfully received versus not. Marketing and methodology and cost. There was a question about that. This is the next item. So timeline wise, depending on the state of preparedness, depending on the complexity of the audit needed, let's say it's commonplace to be able to get through the SEC process in 2 months and have 2 months of preparation to get to the point that you file with the SEC. So say 4 months, and then you're live on the 5th month for up to a year. That's that sequence of it, that part of the sequence. And the upfront cost of reaching that point, pretty much the low end of the range of the costs there with a simple audit will be 150K, all in costs to reach that point in approximate form. Then when we go live, if we're doing this online, then the initial ad spend is typically the ad agency on behalf of the client will spend $10,000 a month in advertising in the first month, which is all testing and tuning. It's all about tweaking. We bring in all of the service providers and, most importantly, the marketing agencies, and we are involved in guiding, advising, and helping challenge them, with the decisions always being made by the client. But where we challenge them to do great work and to use different tools and instruments as needed in order to make maximum success at minimum cost. But going back to what does it cost and stuff. So the typical Reg A plus online, in that first month spending 10K, will raise 30 to 50K. We've had it be as high as 120K in the first month, but that's unusual. So 3 to 5X is normal, whilst we don't know what we're doing, right? We're testing and tweaking and adjusting audiences and advertising, and the landing page content. We'll do multiple landing pages if we need to, and we're doing that. We've done that. It's a really powerful instrument to use. So the point here is that at the front end, you're not raising megabucks, but you are getting efficiency higher. And as we get the efficiency higher, then you will want to spend more money and start ramping up the raise. That part is all obvious. So month 3, month 4 is when the amount of capital flowing in is much, much more sizable, assuming that we're succeeding. And there are no guarantees of success, right? All you can do is do your best. And that's what we bring to the table, is we do our absolute best to help our client companies. That isn't a guarantee, though, of success, is it? The part that matters most in that is figuring out up front whether or not the inherent appeal is there. Part of that is gut feeling, intuition, knowledge, experience, which we and I bring to the table. Part of it is testing, if you want, right? Test the waters is for that. Okay, so going back to costs, yes. So what does that mean? If you're raising above $10 million, which I think you need to be in this non-SPAC context that we're discussing here, then you're talking 10, 12%, maybe 14% total cost of capital, depending on the approach. More when the underwriter comes in, because their expenses are a lot higher. But when push comes to shove, there's somebody waiting there, Akos. I'm letting them in. when push comes to shove, where was I at? Excuse me. Yeah, when push comes to shove, if the underwriter is raising megabucks, the marketing up until that time to create the buzz and excitement around the offering and the fact of the raise that's been made already by that time, make it much easier. And the broker dealer themselves don't need marketing to help them sell the offering to their syndicate. It's already been done in the sense that the momentum has already been built. So in theory, you can reduce the spend for the last few weeks when the underwriter does their bit. Does that make sense? But so there's some savings there, but not mega savings, because their fees are 7.5%, 8% commissions plus warrants of similar face value. Okay, marketing is everything. Timeline I've touched on, costs I've touched on. Post Reg A plus liquidity. I'm going to talk OTC for a moment. It's a little bit out of my intended sequence. Obviously, going to the NASDAQ is the more attractive option for the liquidity that it provides. But I don't know from this audience where you're at, what your plans are. You might have a target market in mind that is relatively easy to approach, relatively less capital intensive, and you may love the idea of an OTC QB or QX destination, which you can do with Reg A plus. One advantage of that is that when listed, you still only need a US GAAP audit once a year. So that's a heck of a lot less demanding, right? You need obviously to report to the SEC and your investors promptly any material change in the business. If you're on the QX, you need management financials quarterly, but still only an annual audit. So it's an easier journey from a reporting obligation standpoint. The biggest issue with all of these listed companies being public on any of these exchanges, the NASDAQ, the NYSE, OTC, QB, and QX, is that it's too easy for stockbrokers to put naked shorts on the stock. That is the serious, most biggest issue, which is where being ready for the post-IPO period is critically important, which we help with that too. We have a consulting service to help with that. But nothing, that's the real point, right? If you are, however, making a series of acquisitions and have a series of announcements about that practice, that's going to really help, right? Of course. Timely announcements that put the frighteners on the naked short people, so they'll go find some other company to short. That's a very good strategy. Okay, there's other options in Reg A Plus now that I don't think are as relevant in this context, but alternative trading systems are a nice, easy way to list your company where there is no shorting at all. No naked shorting, no shorting, just buying and selling of your securities if you choose to list there. I like that very much personally for many companies, but it's kind of off target for the SPAC and non-SPAC approaches that we're discussing here, right? For mega transactions, you want to be listed on a major exchange. You can do successive Reg A pluses every year until you are on the NASDAQ. Actually, excuse me, what am I saying? My gosh. Even on the NASDAQ, you can do secondaries with Reg A plus. My point being that you might consider using that as a way to provide support for your stock in the market. Do a small raise every year, keep the costs down of doing so, and the dilution down of doing so, and that can be an effective way of maintaining your stock price at a sensible level. But that's a little bit of a digression from the SPAC topic. How are we doing on time? Not too bad, not too bad. Okay, mistakes to avoid. Then I'll get to the questions. Looks like we've got quite a few questions. You are allowed to, if you plan and describe your Reg A plus correctly, you are allowed to have a zero minimum raise. So then you're doing escrow closes or segregated account closes every week, as frequently as you choose to, every month, whatever it might be from the get-go. Don't establish a low maximum raise, because why do so? having a high maximum raise gives you the flexibility to raise more money if it turns out to be easier than you thought, or if there's some attractive developments on your radar that now you want more capital for. There's no good reason to have a low maximum. It's your business how much money you really intend to raise. Don't do tier one unless you're a bank, and even then, it may not be the best idea. Probably in 2020, 2 or 3% of capital raised via Reg A Plus was in tier one. It's so difficult dealing with the states. Virtually nobody does that anymore. A 2-year audit confuses people. If your company only existed for a year, you need a 1-year audit. US GAAP audit, you don't need 2 years. Although for other reasons, you may want 2 years, as discussed earlier. Covered that. High investor per investor minimum is really makes the marketing cost very high. So just know that going in. When you imagine the cost of your social media advertising, drawing in an investor, they were doing something else. They see an ad they find appealing, they come in and they're interested to know, can I make this investment? Is it allowed? Can I afford it with my play money? Because right now I know nothing about this. This has to be play money, low number. And then, is it attractive? Is it real? Et cetera, follows. If the minimum is high enough that they get put off by it, they'll just go away and you won't get them back. Then you wasted that advertising money. So it's obvious, but it's not necessarily that obvious. So that's why I mention it. Expensive law firms who haven't done it before charge an arm and a leg and take forever. And big name auditor, we had one company intending to do an NYSE IPO back in 2017. And the CEO was dedicated to using a big name law firm. The company had multiple locations in the US and outside the US. It had 2 subsidiaries outside the US. The big auditing firm was never able to get an audit done in time for the Reg A Plus filing to take place successfully, because they were a tiny company on the scale of things, and they had B-level employees working. They never got it done in time. It killed the offering. The board vetoed the CEO's plan and took the whole IPO agenda off the table. This was a company growing at about 80% a year whilst making a decent, very healthy profit. It was a very attractive business in a strategic space. Debit credit cards account for 50 or 60% of retail investing. That's a very interesting dynamic. The smartphone, people mostly invest via their smartphone now for Reg A Plus offerings. There's a lot of work involved. Don't underestimate that. It's not a remote control thing where you just hand it all off and it happens. You have to be heavily involved. We guide and advise and engage in all of that, of course, with our clients. You can't neglect social media comments. Now it's a bit too much detail there, I think. Yeah, covered that. Yeah, okay. Now I will go to the questions. Hopefully you guys are enjoying this. I like public speaking, and I guess you can probably tell. Yeah, you don't have investors in a Reg A Plus. Okay, so let me step back and hit on a couple of the important characteristics of Reg A Plus. Investors of any wealth level can invest. As far as the SEC is concerned, they can come from anywhere in the world, as long as it's not places like Iraq, Iran, North Korea. So Europe, Asia, there's a lot of very attractive investment audiences that are allowed to invest. They do not have to be accredited. A non-accredited investor is capped at 10% of their net worth or their annual income, whichever is larger, per Reg A Plus investment. And they self-state that. An accredited investor self-states. We don't have to verify that they're accredited, and they have no limit how much they invest. They are not required, though. There's no restriction on that. The offering can be marketed far and wide online, where there's a clickable link to the offering circular and the offering page, which has the offering circular on it. Okay. I'm going to go to the list of questions now, so bear with me while I do that. If I can Yeah, good. I'm looking through this tiny porthole. I probably can do a better job than that, but let me go to the top of the list. You saw the disclosures, very good. You read the disclosures, even better. Hey, Andrew, you'll have to explain to me what you mean by GME. I don't understand the question. Wow, lots of disclaimeries there. Yeah, that's true. Good. Would it be possible to file a Reg A plus offering to describe my real business activities and mention that the company plans to acquire a specific company that has potential synergy as soon as we complete the public offering? This would enhance the value of the Reg A plus company. You don't have to wait 2 years to combine with an unspecified company. And in a SPAC, you don't have to wait to do it either. You do it as you go. But to answer your question, yes, it's fine to do that. If the objective of the raise is to buy that company and it costs $12 million, then you have to have a minimum closing of $12 million to raise, before you can draw down any money. But if the raise is to grow your business and you would like to acquire that company, then you can do so after the fact, but that is not the objective of the raise. The completion of the SEC qualification can be one of the hurdles that triggers the availability of the offering of the transaction, for example. Yes, I've answered that question. Does Manhattan Street Capital help with marketing and sales if the company goes through? Yes, we do help if you go through the SEC process by yourselves. What's the budget required to have a successful? I covered that later. It's going to cost a lot, but if you've got it where you're doing closings as you go, then the cost is coming out of the raise proceeds. But think, for a large raise, think 10 or 12% cash cost in that range. Can you raise a Reg A plus capital if you're already listed on the NASDAQ by selling treasury stock? You can do a secondary if you're already listed on the NASDAQ for any legitimate security. It can be a debt security, it can be a bond, it can be equity, it can be common, it can be preferred. The treasury stock would be okay, you'd have to make sure that it's legitimate stock, but I'm sure it would be. Qualified investor requirements, answered that. How do I think the industry will respond to this use of Reg A plus? I think, I don't really know, right? The SEC part is the most important one. Here I am spouting off, trying to help. I think I'm pretty knowledgeable about this stuff, but the SEC might look back at, well, the real estate deals they've done, which are essentially SPACs, and say, oh, I hate that. We should stop doing that. They've done loads of them already. you know, I would say as of now, I talked about one company, but more than $1 billion, maybe $1.5 billion has been raised by companies doing SPAC-like transactions in real estate only. But so I think the SEC is the key pivot here, but really it comes down to doing it right, doing it the way that I hope I'm describing here, where it's a legitimate offering that fits with the requirements and the intentions of Reg A plus. Raising money for a company that plans to do a business and grow by acquisition is an entirely legitimate thing to do. That's entirely legitimate and always has been by my interpretation of what Reg A plus says. There's never been a ban, oh, you can't buy companies. No, no, no. You can't call it a SPAC, for heaven's sake, right? But I think it'll be fine. At the end of the day, I think it'll be fine as long as the offerings are filed properly with the SEC. If you offer an issue in the UK or Australia, don't you need permission to sell there? Well, that's where it gets interesting, right? Because you have to choose if you are going to if you're going to raise money outside the USA, if you want to take a risk that the regulators in that country will or will not like what you're doing. Up until now, the companies that we've helped, which raise money offshore, have not had any protests or complaints whatsoever outside the USA. Canada being the exception, where you need to file state by state to get approval, or just don't take money from Canada. But that's a fair question. You know, the SEC has no clout outside the USA, right? It's respected highly, but it has no clout. We will be forwarding to the attendees of this call a link to the blog post, which will have a recording of the webinar with a clickable index, so you can just see the interesting bits, not all of it, as much of it as you want, right? Anyway, that'll happen. It's a new rule off the, yeah, so the cap is because of President Biden putting a freeze on stuff that had not yet been enacted. And even though apparently that freeze may or may not apply to the SEC, probably doesn't. We don't really know. The SEC can or cannot follow that guidance at the moment. Nobody knows. It certainly is the case. They did not publish the increase to the 75 mil on the Federal Register, which means it is not currently effective. The intention was that it would be effective soon, but it will not be. It is not now. We don't know. Is Reg A Plus getting known in London, UK financial circles? I don't know. We hear from companies in the UK, but I can't speak to the ambient knowledge there. So the question here is debt or equity more attractive, fixed income and so forth, more attractive to Reg A Plus investors? It depends, right? Depends on the terms, and it depends on the nature of the offering. So if it's a real estate deal, they expect debt. That's the norm, right? Decent dividends paid on debt. That is the norm. Selling equity in a real estate deal is difficult because it doesn't fit the norm. Beyond that, though, if there are companies who are doing secondaries that are public, that are penny stocks, they got hammered and you don't have an instant solution to that. So the instant solution, I don't think it's a terribly good idea in that case to go out and offer more of the same common stock that's already hammered through the floor. You can do a reverse split to bring it up, but does that solve the problem? Not usually. In their case, a separate class is what some companies have done that seems to be working well. It has worked well in our experience. And if it's a preferred that isn't the common, the separate, it's a debt instrument that pays a decent dividend, then it's a matter of how often do you pay the dividend. Monthly is more appealing to a retail investor than quarterly or annual. And, what is the level of the return? If you're paying 8 or 10%, that is very compelling to a lot of people if the company has the substance to support the belief that it'll go on paying it, right? So debt instruments can be very, very compelling. Yeah, so recommendation for risk transfer insurance for offerings. Yeah. Getting directors and officers insurance is an expensive thing at the best of times, and there's no difference here. I don't have any particular recommendations for insurance, except that whatever method of raising money you use, you follow the rules, right? We do things in our platform to identify high-risk investors by their behavior, in addition to the obvious things. So that way to me, there's always been two issues here. One is stay absolutely clean with the SEC at all times, because it's so frightening to deal with that giant entity on the rock if you did something wrong. And the other one is to minimize litigation exposure, because we're in the US. Litigation is such a habitual thing here. So in this case, that one's obvious, don't break the rules, et cetera, et cetera. And this one is about not taking on risky investors, having a company do what it says it would do, all the obvious things. I mean, there's a long list. Don't be a target. Don't make yourself a target. Reg D versus Reg A plus. How are we doing on time? We're okay. Reg D versus Reg A plus. Excuse me. Reg D is so much more difficult to market online. It's so easy to use with the VCs, with private equity firms. It's a marvelous instrument. It's a giant business. Reg A Plus in 2019 was just over $1 billion capital raised. I expect that when we have finalized the numbers, 2020 will turn out to be $1.4 billion, maybe $1.5 billion raised, which is interesting. I mean, the whole private equity category is $1 billion a year. But obviously dwarfed, all these numbers are dwarfed by IPOs, and in particular right now by SPAC IPO transactions. So going back to what is Reg D like? Online, Reg D 506C, it's all about appealing to skeptical investors because accredited investors are skeptics. The average investment amount online is 15 to 20K, maybe 25 for accredited investors when they like an offering. But they're smart people, and they want a deal. They want a company that's valued attractively for its future, and they will do their own due diligence, or they'll just write it off out of hand if it's not communicated to them clearly, properly, you know, et cetera, et cetera. So in the case of Reg A plus, I'm not saying this is all good, but this is the case, right? Reg A plus, when it can be marketed to Main Street investors, it is. That's the most viable audience. And they don't pop the hood and don't do enough due diligence. So it's up to the issuer, and when they're with us, it's up to us to help make sure that the disclosures are thorough. We don't assume that they read the offering circular, which is, you know, 100 pages, 150 pages long. A retail investor, you know, we want to defend them from themselves so that they're happy later. Yeah, they're optimists. You'd be surprised the messages. I get copies of the emails that are sent through the platform to make sure that our CEOs are answering the right ones in the right ways, and et cetera, to help them come up the curve. Not just me, but I do too. You'd be amazed some of the questions. You know, a company that's doing its offering, saying it's not listing, saying it's not planning an IPO to the major exchanges for a incredibly long time or ever. And then, you know, somebody invested 4 months later, they ping the CEO saying, when's the IPO? Even though it was very overtly stated on the offering page, you know. So we're dealing with optimists. Out of 100 people who will invest in a Reg A plus, that is to say, the people who engaged and showed interest, and 100 of them that will go through the journey at some point, a couple of them will invest on the first visit. We had a day last week, 2 weeks ago, where 7 out of 10 of the investors made their investment on the first visit in an offering. You know you're dealing with optimists when that's happening, right? So we got to protect them, and they are looking at this in a very different way than the Reg D investors, and they're easier to reach because they never had this before. Okay, Reg A Plus has been out there for 5.5 years, like this company, which, you know, I launched because of Reg A Plus, but still so few people know about it, right? How many divisions of major companies that where they'd like to raise capital know that they could use Reg A Plus to do it and are planning that? Very, very few. It's taken ages to get the awareness up. It still is. We're at the gestation phase still with Reg A Plus, even though it's accelerating nicely, very nicely. Would it be possible to do a private placement under Reg D? Yes, you can do Reg Ds in parallel with a Reg A plus. You know, whether or not all of the investors are required to approve a transaction depends on how you write the share class, the rules of the share class. So that's optional. So, you know, having a lot of investors doesn't have to create a nightmare. But if you had it set up that way, then you would have to go to a lot of investors. But again, they are optimists. Can I cover that what a SPAC is in the current rules? So a SPAC is where a company makes it. It's a special purchase acquisition vehicle where it goes public on the through an S1 to a major exchange, the NASDAQ or the NYSE. raises money through that public offering with the express intent to buy stuff, to buy companies. They don't have to be terribly specific, but they like to be reasonably specific, because if they're specific on a zone like electric vehicles, it's interesting. It makes it easier to raise the money. And if they have a management team that resonates, that fits that, then that's another advantage. Same thing in a Reg A plus offering, right? So then what do? They have usually they limit themselves to, they have to deploy the money they raised in 2 years. That's the norm. And at that point, the investors in the fund or in the company, the SPAC entity, are not required to transition over to the new entity. They're not allowed, they're not required to be a part of that combination with the other company or companies that are being acquired. But essentially that's it. It's a vehicle built exclusively to buy other companies. It has no actual operating business history, typically, and it has no particular plan to build its own technology or its own products, which is different than what I've said here clearly about Reg A plus. This company discloses a Reg A plus investor D&O insurance policy. Okay, good. Having the policy isn't going to help raise the money, but having the policy is going to make it easier on management to feel like they're less at risk. I'm not quite sure if I'm missing something. If the insurance is insuring the investor, that might be a tad expensive, but if it's true, then that would make it easier to raise the money. Yeah, good question. With reference to acquiring plans, if you are overtly planning to buy a company, then you must get audits of that company, typically in your Reg A plus. If you have a general intention to raise money and buy companies, but you are not yet ready to do so, then you don't, of course, right? If you plan, you raise the Reg A plus money, but your initial intent is to buy that company over there, and that's a part of the plan, then you must have audits on that company too, because otherwise it would be silly. So that's a sequence of facts issue, right? Sequence of plan. We're okay on time. And it would drive up the audit cost significantly available. The SPACs, as such, are not a part of the Reg A plus rules. They're not. I said that front-ended in this call. Thank you for that compliment. I really appreciate it. It would be, that's the thing that's missing here, right? Is the interactivity. Here I am talking to my computer screen. You know, I could imagine I have an audience and make the same presentation. Probably it wouldn't be as good because I know you're there. Okay, Craig, Reg A plus for SPAC are available. Yeah, Legion isn't really that. It is and it isn't. It was misleading to me when I first read it. So their initial filing was a SPAC. Well, yeah, it was a SPAC where they said, this is what we're going to do. We're going to go buy companies. And then the SEC came back and said, this is a blank check company, guys. You can't do that. And then they amended their filing and built their own technology and changed the description of the offering to be what I've been describing here. So it started out that way, but it didn't survive past the first set of comments from the SEC. It seems that setting up a SPAC without any operations activities would be easier and cheaper than doing a Reg A plus. Could be, right? Absolutely could be. I don't, it's a horses for courses thing, if you understand the nuances of Reg A plus, which is what I've attempted to convey here, then it'll fit in some cases. In other cases, it won't. If some companies will want to use this method and list on the QX, and they don't have to have a 2-year operating history, right? The inclusion of a genuine plan to build software for this purpose or technology, hardware for that purpose, is not rocket science to do as long as it's actual, right? So, Christ, I've got so many company ideas, it's ridiculous. I just don't have time to do them. But it isn't that difficult to do. But if you go into the NASDAQ, where you do have to have a 2-year history, Is it hard to buy a private company that has a legitimate 2-year history, especially if you like what they're doing? There's a lot of companies out there that are real, that aren't expensive to purchase. But then it's a matter of, your preference. What do you want to do? If you have the clout and the team to where you can do a SPAC via the conventional method and raise megabucks that way, and you are confident that you can succeed with it, and you like the 2-year horizon to get it all, to get the major acquisitions done by, go for it. I'm not saying Reg A Plus is better. How would I know? It depends on your circumstances. Yeah. Okay, any more questions? Looks like we're reaching the end of the, oh, here we go. Can you raise 75 million for a SPAC from a large company, public investors, with a large number of public investors rather than a smaller list of public investors? Well, if it's a SPAC, then you raise money from whomever's most interested through the underwriter. If you're raising money for a company, as we're describing here, which is a non-SPAC, but it's a Reg A plus that offers some of the same benefits, then typically you are raising money from a large number of public investors with the benefits that go with that and hassle, but the hassle isn't as bad as most companies fear. You have the transfer agent for that, for dealing with them on a day-to-day basis, for distributing dividends if you choose to use them for that purpose, that sort of thing. So I'm not sure if I answered that question or not, but if there are any other questions, post them now, because we're reaching the end of the session. Let's see, we're 12:05, so this is a good duration. I hope this has been useful for you guys. That's my intention, right? Manhattan Street Capital, I didn't say anything about, except sort of little mentions here and there. We help companies raise money via Reg A Plus, right? The platform is very deep, very sophisticated. We've got a lot of neat functionality in it, and we advise and help, we quarterback our client companies as much as humanly possible. We're selective on the front end, and we aspire to help companies make sizable raises that are successful via Reg A Plus for them and successful for the investors. That's the whole goal, to be the leading online platform, well, obviously, for Reg A Plus in the USA. No, Reg A Plus as such cannot do a SPAC. No, I said that at the front end of the conversation. I made that overtly clear. The SEC has not amended the Reg A Plus regulations to say, yeah, go for it, do blank check companies or SPACs by another name. They have not done so. But this is from Craig. Craig, if you look at the video when it comes out in a week, you'll see the front end here and the discussion of all the ins and outs of this. So, you'll know where you stand if you study that. I think I know what I'm talking about. And the most important thing here that I want to convey, apart from the disclaimers that you already heard at the front end, I hope, and that are important, is that you can't game the SEC, right? Whatever you do, it has to be legit. That's a serious thing to bear in mind here. No gaming of the SEC. But if you do this method that I'm recommending and you do it properly, then you aren't gaming the SEC. You're following their regulations and you can have great success. And I hope that you do. That's my intention for putting on this webinar.